Good morning. Welcome to this wonderful chapter Index 102. Paragraph number 16. Cancellation and unfavorable modification. Whenever entity makes unfavorable changes, like increase in service period, employee will not like it? No, he will not like it. Increase of target. Increase his target from 40 crore rupees sales to 80 crore rupees sales. Or cancel the option. Then Ind AS 102 requires in recognize planned expense as usual. You will not reduce the expense. Even if fair value goes down, ignore. What we had planned on grant date, that is the minimum expense we will continue to recognize. Okay. However, we can accelerate the future expense if there is a cancellation. We will accelerate the future expense if there is a cancellation. So, in the next question, I am going to show you this cancellation. Sometimes the entity may have to pay cash to compensate the other party. If you are cancelling the option, to the extent of fair value on the date of cancellation, to the extent of fair value on the date of cancellation, debit SBP reserve account, it is as good as buying back the rights to acquire share. Any excess payment made is treated as a loss, charged to P&L account and to bank. If any balance remains in SBP reserve account, that balance is transferred to general reserve. The logic of transferring to P&L account on payment, if the company pays more than the fair value of the option on the date of cancellation, it is a loss to the company and hence charged to P&L account. It's a loss to the company. Up to the extent of fair value, you are buying back your rights which was given to counterparty. Beyond that, if you pay, it is a loss to the company. So there is a question number 44 which is taken from study material. A very good question, right? For exam purpose, very important. They will ask you for 4 to 8 marks. Same question they will copy paste. Anara Fertilizers has issued 2000 share option to its 10 directors for an exercise price of rupees 100. The directors are required to stay with the company for the next 3 years. So first we underline 2000 options, 10 directors, exercise price 100, vesting period 3 years. Okay. And what is the fair value of the option? 130. So these are the fundamental details. Now, first year we are expecting only 8 directors will be able to serve for 3 years. So that is my first year estimated number of employees who are going to satisfy. So first year calculation is based on 8 directors. So how much will you recognize? Tell me. 2000 into 8 directors into fair value 130 divided by 3. 3 years are there. 693,333. This is year 1 expense. This is year 1 expense. Now you go to year 2. There was a crisis in the company and management decided to cancel such scheme immediately. Oh. So vesting period was 3 years, but in 2 year scheme got cancelled. So what will happen now? It was estimated further as below. This is the fair value of the option at the time of cancellation, fair value. Market price is 99. Market price of the share is 99. Now there was a compensation which was paid to directors, and since only 9 directors were currently in employment, only 9 directors. So what I'll do, I'll calculate total expense now. Total expense will become 2000 into 9 directors into fair value 130. This is my planned expense. This is my planned expense. This much should have got recognized. Minus 693,333 already got recognized. So 16,46,667 I will fully recognize in the second year. Next matter is payment. During the year of date of cancellation of such scheme, hence amount to 95 per option has been given to 9 directors. How much cash is paid? 95 rupees per director per option. So cash paid will become 2000 into 9 directors into 95. That will be cash paid. 17,10,000. Very good. But what is the fair value at the time of cancellation? The fair value will be 2000 into 9 into 90. Come on. 16,20,000. But you paid more. How much more? 90,000 rupees more. This 16,20,000 SBP reserve debit, and this 90,000 P&L and debit, and this 17,10,000 bank credit. Any balance left in SBP reserve after this entry, transfer to general reserve. Understood? So I have explained you the whole problem. Now we have to write it neatly in the notebook because this is a highly potential question for exam. First, step 1, calculation of expense. Calculation of expense. So we will write the formula. In the exam, must write formula. Otherwise, some examiner, they deduct marks for this if you are using the formula. If you are using tabular format, then you have to write column headings. Number of options expected to vest into fair value of the option on grant date into expired period upon vesting period minus expense already recognized minus expense already recognized minus expense already recognized. After writing the formula, you draw this table. Year, calculation, rupees. Year, calculation and rupees. Year, write down 1. How many directors were expected in year 1? 8. So calculation will be 2000 into 8 into fair value is 130. Fair value on grant date will continue in all calculation into 1 by 3 minus 0. Come on, the answer is 693,333. Try the next year. Next year what happened? They have cancelled the scheme only. So we will calculate the total planned expense, that is what we had already agreed, minus previously recognized expense. Minus previously recognized expense. Come on, give me the answer. Yes, the answer is 16,46,667. Done. Expense accounting done. Now step 2. In step 2 we will write cancellation compensation. everything in working note first, easy to understand. Cancellation compensation, comma, amount to be deducted from equity. Amount to be deducted from equity and amount transferred to P&L account. And amount transferred to P&L account. An amount transferred to P&L account. Right hand side rupees. First point number A, compensation. Compensation 9 into 2000 into 95. 9 into 2000 into 95. 17 lakh 10,000. 17 lakh 10,000. B, amount to be deducted from equity. Amount to be deducted from equity 9 into 2000 into 90. 16 lakh 20,000. Therefore, amount transferred to P&L account. Therefore, amount transferred to P&L account. A minus B. A minus B. Is it 90,000? So this is basic working once we have done. Easy to solve the problem now. Question was how the cancellation would be recorded. Past journal entries. Books of Anara Fertilizers Limited. Books of Anara Fertilizers Limited. Journal entries. First date is 1st April. Year 1. Year 0 add on. 1st April YO. What is YO? Year 0. Year 0. Exact date I think is not given. Correct? No entry. 31st March year 1. 31st March year 1. 31st March year 1. Employee compensation expense account debit. First year was 693,333 to SBP reserve. To SBP reserve 693,333. Being expense recorded. Being expense recorded. Being expense recorded. 31st March Y2. 31st March Y2. Again, go to your working note 1. What was the amount? A huge amount was there. 16,46,667. Very good. Write down. In bracket, keep writing P&L account. Otherwise, I will ask you to pass one more entry. In the exam, transfer to P&L account separately. Otherwise, you will be exposed to losing marks. Right now, we can just do it in one entry. To SBP reserve 1646667. Being expense recorded. Two normal entries. Now we are going to cancel the option, give them the payment. So to the extent of fair value on the date of cancellation, I am going to debit SBP reserve 16,20,000. Correct? Which was your step number 2? In bracket step 2. Source of the calculation. Then write down P&L account debit 90,000, again step 2. And to bank 17,10,000, again step 2. Write down the narration being option, cancellation, compensation paid. Being option, cancellation, compensation paid. SBP reserve account debit. SBP reserve account debit. Now see, some balance is left there. Some balance is left. You have to use your calculator. Add 693,333, then add this number and minus this number. So you will get this balance. Yes or no? So write SBP reserve account debit to general reserve. To general reserve. Being balance in SBP reserve. Balance in SBP reserve. Transferred to general reserve. Transferred to general reserve. Now see, this 7,20,000 we can cross check also. We have accumulated 130 rupees per option in the SBP reserve, yes or no? You have multiplied by 130 till this point, but you have only debited 90 here. So the benefit is 40 into 2000 into 9 directors. Just try. Yes, so that was the cross check. In this question, it was easily done. Write a note also for future understanding. Tutorial note. Cross check of amount transferred to general reserve. Cross check of amount transferred to general reserve. Under that, write down 2000 into 9 into 40. How this 40 has come in bracket? 130 minus 90. We have recorded at 130 the expense, but the payment was made at 90 rupees only. So this is 7,20,000. This is the excess amount lying in SBP reserve. This is the excess amount lying in SBP reserve. Done. Then your question will be, if compensation paid is less than fair value of the option, what will you do? If compensation paid is, this is note for understanding, okay? If compensation paid is less than fair value of the option on the date of cancellation, on the date of cancellation, the entire excess will be transferred to general reserve. The entire excess will be transferred to general reserve. The entire excess will be transferred to general reserve. Okay. Now what does that mean? I'll just go to the previous slide to explain. Give me 1 second. So suppose in this question the compensation paid was, instead of 95, 85. Instead of 95, 85. So whatever is that calculation, tell me. 15,30,000. It is less than 16,20,000. So these two lines are then not required. You can't record the gain in the P&L account. Even though you paid less than fair value, can't record the gain. The entire payment, first you debit SBP reserve to bank, and then whatever surplus is left in SBP reserve will be transferred to general reserve. Gain will not be recorded here. If the payment made is below fair value, then pass entry only for the payment made. So these two will not come. And while passing the journal entries, you will record here in the third entry SBP reserve account debit. What you said, 15 lakh? 15 lakh 30,000. Nothing will come in P&L account. To bank you will write. And then whatever is left in SBP reserve, transfer to general reserve. So this entry will not come. And this balance will shoot up. Okay. Any excess will go to P&L account. General reserve. This was the meaning of this paragraph. However, I have seen no question has come in the exam or in study material or RTP or MTP. In all questions they have given you payment made is more than fair value. But past is not the guarantee of future. Is it right? Read the offer document carefully. Read the examination question carefully. Question number 45. Source is your diploma IFRS UK exam, but relevant for you, very important. Same problem, one more practice. An entity introduced an equity settled share based payment scheme on 1st January 2080 for its 5 directors. How many directors? 5. And what is the grant date? 1st January 2080. Under the terms of the scheme, the entity will grant 1000 options to each director if they remain in employment for 3 years. So these are some basic data which I will require. These are basic information. 5 directors, 1000 options, 3 years. All 5 directors are expected to stay for full 3 years. Very good. The fair value is 8 rupees. So this is also relevant. 8,035. These are fundamental data. Now see, on 30th June 20x1, and what is the date mentioned here? 1st January. Grant date and 30th June. What is the gap? 1 year and 6 months. 1 year, 6 months. So 1 year full, but then next year after 6 months only, the entity decided to base its share-based payment scheme on profit-based target. It therefore cancelled the existing scheme. So cancellation took place here. Doesn't matter. First year I will do normal accounting, 1/3 into 1000 into 5 into 8. Then next year I will first calculate the remaining expense minus previously recognized expense. Okay. On 30th June, it paid compensation of 10 rupees per option to each of the directors. This is payment made. Fair value of the option was 9 on this date. So 1 rupee excess paid will go to P&L account. Required. Explain with calculation, as if I am going to send a voice note. Okay. How the cancellation and settlement of the share-based payment scheme would be accounted for the year ended 31st December 2001. We have to pass entry for 2 years. Okay. First year, second year, exactly same problem. Do you believe? Yes. Then the difference is here all directors are surviving for the 3 years or 1.5 years in this example. Nobody left. Remaining question is same. So start with the formula. Everybody start. Question number 45. Step 1, calculation of expense. Formula is very big, but you have to write number of options expected to waste into fair value of option on grant date into expired period upon vesting period less expense already recognized. Less expense already recognized. Less expense already recognized. Again format is same. Year calculation rupees. Year calculation rupees. Come on. Year 1. Year 1. 1000 into 5 into 8 into 1 by 3. 13333. Is it right? Year 2. Year 2. 1000 into 5 into 8 into 1.5 upon 1.5. What is 1.5? This program got cancelled after 1.5 years only. Is it right? The scheme got cancelled after 1.5 years. Now one good news, if you don't want to write this 1.5 and 1.5, then don't write. It's okay. Calculate the total expense minus previous year. If that helps you, 1000 into 5 into 8 is my total expense minus previous year. Some student got confused. They were looking at anger at me. Okay, what is 1.5? 1.5 is total period after which program got cancelled. So anybody answer? That's right. 26667. 26667. 26667. 26667. Step number 2. Cancellation compensation amount to be deducted from equity. Cancellation compensation expense amount to be deducted from equity and amount transferred to P&L account. So this is a working note. It will help us to pass journal entries. Yes. Solve. Try yourself. Like previous question, 3 lines are required. Student is trying. I will check. How much cash will be paid? How much will you transfer to adjust in SBP reserve? And how much will you transfer to P&L account? Come on. Anybody? Cash paid. Compensation paid. 50,000 is the right answer. Then amount to be deducted from SBP reserve. Hanji? 45,000. Wonderful. Now you have learned. Now you can do more homework. Amount transferred to P&L account. Amount transferred to P&L account 5,000. Today's homework is you will revise all questions, okay? So that this chapter, which is a very easy chapter, you will get full marks in the exam. There are not many varieties here and not many complicated calculations also. And these are 8 marks bonus marks. Done? Next step number 3, write down journal entries. Like previous question, same to same problem. India and UK are united on this question, okay? 1st January 20x0. No entry because only contract was entered into. 31/12 X0, 3112X0, employee compensation expense account, in bracket P&L account, debit 13,333, 13,333 to SBP reserve 13,333. Yes, being expense recorded. Repeat the entry on 30th June now, 30th June, because they said that this scheme will be cancelled on 30th June 20x1. Write the date properly. Entry is same, amount will change. What was the second year amount? 26,667. Wonderful. Being remaining expenses recorded. Being remaining expenses recorded. Next. What is the third entry? Guess. For payment, cancellation, transfer to P&L account. Okay. On your own. Refer the previous question, pass the entry. I will check after 30 seconds. Just change the figures. Previous question is there with you. SBP reserve account debit 45,000. P&L account debit 5,000 to bank account for 50,000. Correct? Narration. Being option cancelled and amount paid. Being options cancelled and amount paid. A brief narration you have to write. Now all of you will go through your SBP reserve account and tell me how much is the balance left. Huh? Just 5,000. Positive or negative? Negative balance. Negative balance also will be closed by transfer to general reserve. I have to close that account because that share based payment scheme does not exist anymore. So even if it is negative, it will be transferred to general reserve 5,000. So that is why I took this question. 5,000 being balance in SBP reserve transferred to general reserve. Balance in SBP reserve transferred to general reserve. Next is I will give you some important notes, tutorial notes. Because in this question the student had asked me a query, what I will do with the negative SBP reserve. The answer is same, what you do with positive SBP reserve. Okay. So write few notes in case if you have any doubt in future while revising. Read the note first. Every question I am giving you the important notes where you may have doubt. After reading that still you have doubt, then you mail me. Okay. Any payment made in compensation for the cancellation, any payment made in compensation for the cancellation, that is up to the fair value of the option, that is up to the fair value of the option, is recognized as a deduction to equity, is recognized as a deduction to equity. Any payment made in excess any payment made in excess of the fair value is recognized as an expense. Is recognized as an expense. Second note, write down: the compensation paid to the director, the compensation paid to the director for each option exceeded the fair value, exceeded the fair value by rupee 1, exceeded the fair value by rupee 1, in bracket, that is rupees 10 minus rupees 9. Therefore, an expense of rupees 1 per option, therefore an expense of rupees 1 per option should be recognized in P&L account. Should be recognized in P&L account. Next point, write down: employee compensation expense will be transferred to P&L account. Employee compensation expense will be transferred to P&L account. If you have not transferred separately, at least write a note in the exam. Otherwise, I have given you the instruction in first question. In the exam, transfer separately by passing a separate entry. And if you have not done, at least write a note. Then if SBP reserve becomes negative, last point, if SBP reserve becomes negative, still we can transfer it to general reserve. Still we can transfer it to general reserve. Now come to 46 number, one more practice. Source is same, UK, India, UK, bhai bhai. An entity grants 100 share options to each of the 15 employees in its sales team on the condition that they remain in service over the next 3 years. There is also a performance condition. The team must sell more than 40,000 units of a particular product over the 3-year period. At the grant date, the fair value of each option is rupees 20. So here the target is performance target. 40,000 units he has to sell and he has to serve for 3 years. Today the fair value is 20 rupees. How many employees are there? 15. How many options? 100. So first I'll make a note of all key variables, okay? Then during year 2, oh my God, company increased the sales target to 70,000 unit. Employee, oh sad, from 40,000 to 70,000. Favorable change or unfavorable change? Unfavorable. Almost 70 or 80% increase in the target. It is like increasing your articleship from 3 years to 5 years. Okay, happy? You will get stipend. Right now you are getting 5,000, you get 6,000. No. Same thing with this employee. By the end of year 3, only 60,000 units have been sold and the shares do not vest. Now that is the problem. So I will continue to recognize the planned expense. I will continue to recognize the planned expense. Even in 3rd year, we will recognize the expense because at least it is more than the original target. So ignoring the increased target, we will continue to recognize the expense. Planned expense will be recognized. All 15 employees remain with the entity for a full 3 years. See the loyalty. Okay, even though the management has cheated, management has increased their target so that they will work harder. Okay, it is in their interest only. Earlier they were sleeping 8 hours, now 5 hours. But what is the use of sleeping 8 hours? Tell me, it's a waste of time only. You have taken birth on this planet Earth for sleeping or working? Working, correct. So we are only making you for what the God has created you. Is it right? Work. Calculate the amount to be recognized in financial statement for each of the 3 years. The answer is only one line. 100 options, 15 employee, fair value 20, divide by 3. Huh? Done. Your answer is over. You will still recognize the expense. Okay. But we can't write only this much in the exam. I have to write few more lines. Answer. Calculation of expense. Really speaking, the answer is of one line only. But then let us stretch it. Right hand side rupees. First year. 15 into 100 into 20 into 1 by 3. Minus 0. 10,000. Second year, same calculation. 2/3 I will take and previous year I will reduce. Previous year I will reduce 10,000. Again next year 3 by 3 I will take. Minus 20,000. Minus 20,000. Again 10,000. Suppose you don't have time in the exam, then you can just simply say expense per annum equal to 15 into 100 into 20 by 3. Because the number of employees have not changed. So your answer is 10,000 per annum. Fair value has not changed. Number of options have not changed. Number of employees have not changed. So therefore my answer is 10,000 per annum. So write alternatively. Because exam FR paper is very lengthy. Alternatively, expense per annum equal to expense per annum equal to 15 into 100 into 20 divided by 3 equal to rupees 10,000 per annum. You can see it is right, matching. Journal entries write down. Journal entries, and I will give you a note why we are recognizing expense in the third year also. Okay. Because at least the original target was fulfilled, 40,000 unit. So increased target ignore. What is unfavorable to the employee, ignore. But at the same time, we will not pass entry for issue of share because company is not going to issue him the shares. At least recognize the expense. Entry is same every time. You have to debit 10,000, credit 10,000. Year 0 right, no entry. Check for exact date, not given. Then you have to write year 1. Employee compensation expense account debit 10,000 to SBP reserve account 10,000 being expense recorded. Being expense recorded. Being expense recorded. Year 2, employee compensation expense account debit, 10,000 to SBP reserve, 10,000. Again write year 3, narration homework, employee compensation expense account debit. When you are changing the year, keep one line blank. P&L account 10,000 to SBP reserve 10,000, one line blank. Will the shares be issued? Will the cash be paid? No. Expense will be booked as originally planned. But I will not issue the share because the company will say you have not made the target of 70,000 unit. All expense will lapse. So what will you do? SBP reserve account debit amount 30,000 to general reserve. To general reserve 30,000. Balance in SBP reserve transferred to general reserve. Is it done? Very good. Go to your notes, tutorial notes. Later on, if you have doubt why we have passed entry for expense, so you have to read this note. This doubt will come when we have not achieved the target. Why the entry for expense was passed? Planned expense will be recorded. Okay. IND AS 102 states that a share option scheme, when a share option scheme is modified, the entity must recognize as a minimum the service received measured at fair value at grant date. Service received measured at fair value at the grant date. That is planned expense. Management had made up its mind at the grant date only, this is going to be my expense. Okay. This employee is rendering the service and this is going to be my expense. So you have to account for it because it's all a part of salary package. Either you give him cash or you give him share. So that is a part of salary package. So that expense was already planned. The employees have not met. Second point, the employees have not met this modified sales target. The employees have not met the modified sales target, but did meet. What is did meet? They made the original target set on the grant date, but did meet the original target set on the grant date. This means that the entity must recognize the expense. The entity must recognize the expense that it would have incurred. Had the original scheme continued in force. 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 Noted? So as far as original scheme is concerned, there the target is achieved. I will continue to recognize the planned expense. Then your question will be, what if the target achieved was less than 40,000? Then I will reverse the entry in the third year only. Then the calculation is being done as per the original scheme, right? So if the target achieved was below 40,000, actual achievement was below 40,000, third year we will reverse the expense recognized earlier, which means the entity would not have recognized the expense in the third year, but because that 40,000 target originally planned was achieved, so going by the original scheme, the expense will be recognized. Now, next point, stock option issued by group companies. Is it there? Stock option issued by the group companies. It happens within the group that sometimes the employee is working in parent company. Employee is working in parent company, but shares will be issued by subsidiary. Oh, settled by subsidiary. So draw this diagram in your notebook. Case 1. Case 1 is employees of parent settled by subsidiary. Employees of parent settled by subsidiary. So this diagram will help you to visualize. There is an employee here. He is rendering services to P for parent. Okay. So who is enjoying the benefit? Parent is enjoying the benefit. But who is going to settle these employees by issuing shares? Subsidiary. How to do the accounting? In SFS and CFS. How to do accounting in SFS, separate financial statement, and CFS, consolidated financial statement. Done. Case 1, employees of parent settled by subsidiary. First question is, why will subsidiary issue shares to employees of parent, and why employees of parent would want the shares of subsidiary? Why don't they ask the share of parent only? Answer is very simple. You can also imagine. Okay, yes, guess. Why will employees of parent company demand the share of subsidiary company? You'll get more shares. You'll get control. Employees will get control over subsidiary. Parent is already controlling subsidiary. Indirectly, they will get share in parent. How is it possible? If subsidiary issues shares to employees of parent, how will they get stake in parent company? Parent has a stake in subsidiary, but then employee should get shares of parent only. Why some other company is giving him shares? It is unlisted company, and subsidiary is a listed company. If I tell you, you are my employee, take my share, but I am an unlisted company. Even if I issue the share to you, whom will you sell? Can you sell? You have to go to your friend and say, see, I have shares of ASF. You want to buy? He will think that where will I sell? But it is a listed company. But I tell you, don't take our share, take my subsidiary share. I and subsidiary will settle among ourselves. You don't worry. But you work for us, get the shares of subsidiary, which is listed, which is more recognized in the market. Okay. So what will you say? Yes. Because you will get the share, It is traded in the stock exchange. You have liquidity. In any working day, you can sell the shares. And the prices are also known to you on a daily basis. Here you don't know what is the worth of the share you are getting. Because unlisted company means their market price is not available. Then you have to get the fair valuation done by some valuer. And as you have learnt in your SFM, valuation is a subjective exercise. Is it right? Some people say Zomato's value is 140 rupees. Then I applied all my SFM formula, it comes to 0. It should be minus, but I can't write in minus actually. Mathematically it was minus, but let us say on a higher side 0. But then people are paying 140 rupees for that. So same thing. So unlisted company, as long as Zomato was unlisted, nobody knew what is the value of this share. Now people know. Now they are willing to buy. So that is the reason. What about accounting treatment now? Parent is receiving the service, so parent will debit the expense. But parent is not going to issue the shares now. Shares will be issued by subsidiary doing favor to the parent. When subsidiary is doing favor to the parent, it is as good as subsidiary is paying dividend to the parent. Oh, so if subsidiary is making payment on your behalf, indirectly treat it as a dividend received from subsidiary. So I will credit equity account, retained earning, and treat it as dividend. Treat it as dividend. In Peace book. It's written in your book also. And what subsidiary will do? Subsidiary will treat it as if it is paying dividend to the parent. Entry is written in the book. So those who don't want to write, don't write. Entry is written first A. Employee benefit expense account debit to equity, other equity. It is treated as if dividend was paid by subsidiary. So subsidiary will do reverse. Subsidiary will treat it as dividend distribution to parent. So equity account debit, maybe retained earning debit. Treat it like you are paying dividend, but subsidiary is required to create SBP reserve. So expense will be debited here, parent book, because parent is enjoying the service, but the obligation to pay the share is with the subsidiary. So subsidiary will create SBP reserve. For parent, it is dividend received from subsidiary, and for subsidiary, it is as good as dividend paid to the parent. Okay, so that is about case 1. Now don't worry, I have written the entry in your book. In any share based payment which is equity settled is to be settled by issue of equity shares by any group company, then following entries are passed. Case 1, employee of the parent settled by the subsidiary. Books of parent entry will be employee compensation expense account bracket P&L account debit to equity or other equity bracket write down, which is not printed in your notes probably. It is treated as if it is a dividend received from subsidiary. Okay, treated as, write down in bracket, treated as dividend income, being expense recorded, as good as expense recorded. And then there is a note here, employee compensation expense will be transferred to P&L account. That is normal. What subsidiary will do? Subsidiary will treat it as if, fill in the blanks, it has paid dividend to the parent. So then in that case the entry will be equity bracket other equity bracket treated as dividend distribution. Write down, in bracket write down, treated as if it is deemed a dividend, as if it is a dividend paid by subsidiary. Either you pay directly cash, but here you are incurring expenditure on behalf of the parent. Here you are incurring expenditure on behalf of the parent. So it is as good as favoring the parent to SBP reserve. So every year both parties will keep on passing these two entries. And then when the shares will have to be issued, as usual, SBP reserve to share capital to securities premium in the books of, hello ji, in the books of subsidiary. Okay. This will be separate financial statement. Now I'll come to consolidation. So now we'll come to consolidation. So in consolidation, what will happen? Common items are eliminated. In consolidation, what happens? The common items are eliminated. So in one party we are showing equity credit. In another book I am showing equity debit. Correct? I have shown equity credit and I have shown equity debit. They will cancel out each other. At the time of consolidation, equity of parent, which you had credited in the books of parent, and subsidiary, which you have debited here, they will be cancelled before consolidation. So far, question of consolidation has not been asked. Only journal entries have been asked. But we don't know what will happen with you in future. Next point, case B. Employees of subsidiary settled by parent. Possible. Same reason. Parent is a reputed company. Parent is a reputed company, listed company. Subsidiary may not be listed company. You are the employee of subsidiary. Subsidiary is telling you, employee, come here, I want to give you ESOP. Okay, you will become owner of our company. Employee will say, keep your ESOP with yourself only. You are an unlisted company. Nobody knows you. You are just manufacturing component for parent. So even if I take the share, one, I will not be able to sell it. I have to meet people personally to sell. Convince them, is this my job? Am I a salesman of shares? And secondly, we don't know what is the worth of these shares. Because you will do the fair valuation, which will be by a valuer appointed by you. He will not trust. Is it right? If I tell you ASF share I have valued is 2000 rupees per share, will you agree? No. My God, such a big insult. Had it been listed and if the market price was 2000, you would have agreed? Yes, that is the difference. So employee insists, I get the share of parent. Parent says no problem. Ultimately, work done for subsidiary is work done for me only. Yes or no? Work done for subsidiary is work done for parent only, because subsidiary's profit is enjoyed by parent. So it agrees. When parent will agree to issue shares to the employees of subsidiary, now you have to visualize what entry parent will pass. For parent, it is indirectly a form of investment in subsidiary. Instead of making direct investment, I am indirectly investing by incurring their expense to SBP reserve. And what subsidiary will do? Subsidiary will book the expense. Employee compensation expense, because it is enjoying the services. So it should get a hit in the P&L account. Matching concept. Revenue must be matched against expense. And credit will be equity, which will be called capital contribution by parent. Separate books. And then what they will do, when they will prepare the consolidation, these two will cancel. So in consolidation, the common item will get cancelled. What will remain? Expense will remain, SBP reserve will remain, and this common item will get cancelled. Is it right? So now we'll come to entry in your book. Books of parent. Parent will treat it as if it is investment in subsidiary to SBP reserve, being SBP reserve recorded, and subsidiary will record the expense because it is enjoying the benefit of services of the employee. So those who enjoy the benefit will book the expense. Employee benefit expense, which will be transferred to P&L account, and to other equity. In SFS, they will create one account, other equity contribution from parent, and in consolidation it will get cancelled off. This will get cancelled. Investment debited in parent book will get cancelled. Okay, being expense recorded. Just write a note here. You have some space. Investment in equity and contribution from parent will be cancelled at the time of consolidation. So far, this adjustment in consolidation have never been asked. I have seen all the study material, RTP, MTP and exam. Even in other books also, there are no questions on consolidation of a situation where parent issues shares to employee subsidiary or subsidiary issues shares to parent. So it's a concept. For 4 marks they will test you. Okay, so I have found such contributions are considered for, but goodwill was already calculated when the control was acquired. Oh, so it won't affect goodwill, na? When is goodwill calculated? Ind AS 110, on the date of acquisition of control. And then as long as control exists, goodwill is not recalculated, but goodwill can be impaired. Okay, so it won't affect goodwill right here. It won't affect. It's like an intercompany transaction after acquisition. It is like an intercompany transaction after the acquisition. It won't affect goodwill because goodwill is calculated. Although you have asked an irrelevant question, but yes, somebody else will also think like that. It is because it won't affect goodwill because it is calculated. It is calculated on the date of acquisition and is not remeasured except in case of impairment. Except in case of impairment. Anyway, that was just for knowledge purpose. Now let us take question 47, 48 and 49. These 3 questions are appearing in different institutes material. A parent grants 200 share options to each of 100 employees of the subsidiary. Who is going to issue share? Parent. And who is enjoying the benefit of employee services? Subsidiary. So employee of subsidiary settled by parent. This is our case B. Okay. Conditional upon the completion of 2 years of service, fair value of the option is 30 rupees. And at the grant date, subsidiary estimates that 80% of the employees will complete 2 years of service. The estimate does not change during the vesting period. At the end of the vesting period, 81 employees complete the required 2 years of service. So first year estimation will be based on 80%. How many employees are there? 200. 100 employees. 80% initially was estimated will complete 2 years of service, which they said did not change. And into 200 into 30 divided by 2, that will give me first year answer. So that comes to, I will write neatly later, you just understand. But when I go to the second year, now the number of employees have become 81. So now I have actual figure. So 81 employees into 200 shares into 30. This is total minus previous year. 2,46,000. Basic calculation you have learnt now. Same calculation, same entry will be passed in the books of parent also, subsidiary also for 2 years. And then who is going to issue the share? Parent. Then parent will issue the shares and then pass entry for issue of share also. Parent does not require subsidiary to pay for the shares. Subsidiary is not going to compensate the parent. If the subsidiary is not going to compensate the parent, it is treated as investment. It is treated as investment. Pass necessary journal entry. They have to mention necessary, okay? Otherwise, student will write students Ind AS, not ICI's Ind AS. If you have not learnt it before, you will show your creativity in the exam. Some student will prepare consolidated balance sheet also. So are you ready to solve? First start with a note. First write down a note. As required by IND AS 102, over the 2-year vesting period, the subsidiary measures the services received. The subsidiary measures the services received from the employees in accordance with the requirements applicable to equity settled share based payment transactions. Subsidiary measure the services received from employees in accordance with requirement applicable to equity settled share based payment transaction. Is it right? So on the first day of this chapter we said even group policies are also covered by this standard. So subsidiary is receiving the services, subsidiary will continue to follow equity settled share based payment entries. Okay. The subsidiary measures the services received The subsidiary measures the services received on the basis of fair value of fair value of share options at grant on the basis of fair value of share options at grant date on the basis of fair value of share options at grant date. Then point number 3, an increase in equity is recognized as a contribution from the parent. An increase in equity is recognized as a contribution from the parent in the separate or individual financial statement of the subsidiary. In the separate or individual financial statement of the subsidiary. So what I have written here is just the provisions of the standard. Again, so have you written the note? Any query? If you have time in the exam, then write this note. It is nothing but the provisions of the standard as to accounting in the books of subsidiary. Subsidiary will record the expense, subsidiary will credit capital contribution from parent in their separate financial statement. That is what they have written. And then do the calculation as usual. Do the calculation as usual for both parties, parent as well as subsidiary. A very important question for 4 marks. It was given in RTP May 19. Calculation of expense. Right hand side rupees. Point number 1. 200 options into 100 employees into 0.80 into 30 into 1 by 2 minus 0. 2,40,000. 200 into 100 into 81%, or directly write 81. Either way, 81 employees out of 100 means 81%, or you can write 81 employees into 30 into 2 by 2 minus 2,40,000. How much is that? Check. 2,46,000. We have discussed it. So keeping these two figures in mind, now I'll pass entry first in the books of parent and then we'll pass entry in the books of subsidiary. Step 2, journal entries in the books of parent. What entry parent will pass? Is the parent recovering any compensation from subsidiary for issuing the share? No. Then treat it as investment in subsidiary. Year 0 grant date, no entry. Year 0 grant date, no entry. Year 1 reporting date, investment in subsidiary account debit 2,40,000 to SBP reserve 2,40,000 to SBP reserve 2,40,000. Is it right? To SBP reserve 2,40,000. Being option granted to employees of subsidiary. Being option granted to employees of subsidiary. Being option granted to employees of subsidiary. And then write down year 2. Year 2, again same entry, change the amount. Investment in subsidiary account debit, 2,46,000 to SBP reserve. To SBP reserve, come on. 2,46,000. To SBP reserve, 2,46,000. Narration is homework, keep 2 lines blank. Who is supposed to issue the shares? Parent is supposed to issue the share. One more entry, year 2. SBP reserve account debit. Tell me the total of SBP reserve. 240 plus 246. 486? 4,86,000. Now search for number of shares. So you will issue 200 option into 81 employees. Correct? Into 10 rupee face value assume. Is there any harm in assuming 10 rupee face value? No. Most of the Indian companies have 10 rupee face value. 1,62,000. And to securities premium balancing figure. 3,24,000? Right. Being shares issued. Being shares issued. This is my entry number 3 in the books of parent. Any query? No. Okay. Now write down in the books of step 3 in the books of subsidiary journal entries. In the books of subsidiary journal entries. Year 0 grant date no entry. Year 0 grant date no entry. Year 1 reporting date employee compensation expense account debit 2,40,000 to equity 2,40,000 to equity 2,40,000 being expense recorded. Again write year 1. Year 1 penal account debit 2,40,000 to employee compensation expense account 2,40,000 being amount written off. Reporting date year 2 reporting date employee compensation expense account debit 2,46,000 to equity other equity in other equity write in bracket contribution from parent everywhere here also, and then transfer this to P&L account. This way you will write the entries in the exam. You will get full marks, whatever 4 or 8 marks allotted to this question, anything between 4 to 8 marks. With narration you will write yourself. Narration in first year I have given, second year you will do yourself. Will the subsidiary issue shares? Subsidiary is not going to issue the shares. Parent has already issued. This answer is over. Question number 48. Just check, is the answer also there? So we'll discuss in the classroom. Okay, don't worry. A parent company P grants 30 shares, same problem with different figures and one extra adjustment. Grants 30 share. Parent company P grants 30 share to 100 employees, each of its subsidiary S, on the condition that they remain in employment for 3 years. Parent will give shares to employees of subsidiary. Same case, share issued by parent, services enjoyed by subsidiary. Assume that at the outset and at the end of year 1 and 2, it is expected that all the employees will remain in employment for all the 3 years. So you can do the calculation only once and divide by 3. At the end of year 3 also, none of the employees left. I wish every organization has such employees. For 3 years, an article does not stay for 3 years. 2-3 bosses they change. Still stuck to one boss only. So sad. I changed 3 bosses. Okay, I did not like them, I'll change. Coincidentally, my first boss name was Heman Joshi. Second was also Heman Joshi, but 2 different Joshis. Okay. And one was Maharashtrian, one was Gujarati also. But they still love me, even though I left them in between. The fair value of third name I will not take. The fair value of the share on the grant date is rupees 5 per share. So 5 rupees used for accounting. So tell me 30 into 100 into 5 and divide by 3. 5,000 each year. 5,000 each year into 3, total 15,000. But this time this line is extra, so I have highlighted it. You also highlight it. Company S agrees to reimburse company P over the term of the arrangement for 75% of the final expenses recognized by company S. So what is 5,000 into 75%? 3750. 3750. So this time while passing the entry, parent company will write investment account debit, bank account debit 3750 to SBP reserve 5,000. Okay, which means I will treat only the balance amount as investment, because out of 5,000 they are compensating me. Yes or no? They are compensating me 3750. And similarly, what subsidiary will do? Subsidiary will write employee benefit expense. I don't have space to write, so I'll erase employee benefit expense. They will write 5,000. But first they will write to bank 3750, and then remaining will be equity contribution by parent, like this. So that is a small change. Let us see whether they have done the same thing. So first is company S expects to recognize an expense totaling 30 share into 100 employees into 5 shares. Answer is printed in the book. Concentrate 15,000. The total reimbursement will be 75% of 15,000. 11,250. Amount reimbursed each year will be 1/3 of this. That is 3750. 3750. Done? Any query on this calculation? This is a very important question. Write down, very important. Study material is the source. And then we will pass entry in the books of subsidiary company. Amounts are going to remain the same. So what the institute has done, they have said in each of the year, very good. You can't do that in the exam. In the exam, you write 3 entries, okay? You can't write in each of the year. S will recognize an expense in the P&L account, cash paid to company P and balanced in capital contribution. So entry will be repeated by the student 3 times, right here. Repeat 3 times in exam. Unless you are willing to take the risk. That is your choice. So this entry you will write year 1, year 2, year 3. Okay. To recognize the share-based payment expense and partial reimbursement to the parent. And similarly, parent will record investment account debit only 1250 because out of 5000 subsidiary has paid 3750 and to SBP reserve equity, write there SBP reserve. This is not printed. If not printed, then write 5000. And right here on the left side you have some space. Repeat 3 times, left or right side in the exam. Same entry repeat 3 times, and then in the last year, write down last year issue the shares. Last year issue the shares. And I have told you what entry you have to pass for issue of share. SBP reserve account debit, whatever is the total accumulated, to share capital, to securities premium. If the question is silent, assume face value of share as 10 rupees and write an assumption. Done. So this is the answer of this important question number 48. These two questions were based on concept where parent issues shares to the subsidiaries employees and subsidiary gets the benefit of the services. Then you will ask me one more question. What if subsidiary issues shares to the parent? So one example on that also, which is taken from May 2021 RTP. Okay. Company P is a holding company for company B. Who is parent? P. Who is subsidiary? B. Then a group share based payment is being organized in which parent issues its own equity share to employees of B. Oh, this is also same. The details are as below. Number of employees of company B, grant date, fair value, number of shares granted to each employee, vesting condition, face value per share, pass entries in the books of both parties. Now, what is the vesting condition? Immediately. So that is the new thing about this question. Immediately we are going to issue the shares also. So first do the calculation of expense 100 into 87 into 25. This is the value of services. Anyone who wants to answer? 2 lakh? So parent will pass the entry investment account debit to share capital to securities premium because the options have vested, and subsidiary will pass the entry expense account debit to equity contribution from parent. Did subsidiary pay any amount? Hello Ji. This time no. So what is the difference in this problem and the earlier two problem? Here the options are already vested. Options are already vested. So no need of apportionment over the vesting period. So three questions are similar but not exactly same. There are minor differences. So write down books of company P. Books of company P. Investment in company B account debit. 100 into 87 into 25. Debit 2,17,500. To equity share capital. To equity share capital 25,000. 25 into 100, this time face value 10 rupees mentioned in the problem. And remaining difference to securities premium 192 500. Is right 192 500? Yes, 192 500. Being allotment of 25 shares each to 100 employees of B. To 100 employees of B of rupees 87 per share. Done. And then subsidiaries book. Books of company B, bracket subsidiary, bracket subsidiary. So subsidiary will book the expense fully because these are vested options. These are vested options. Expense will be fully recognized. Same amount, 2,17,500 to capital contribution from B. In bracket equity, other equity. Other equity. Institute in different places, they use different name of account. Okay. In study material, they just said equity. In RTP, they are saying capital contribution from parent P. 2,17,500. Narration. Being issue of shares. Being issue of shares by the parent to employees pursuant to group share based payment plan. Pursuant to group share based payment plan. Done. Now what I'll do, I will change the question. Write down. Suppose in the above question, I'll dictate because one example I'll take reverse. Suppose in the above question, the subsidiary issues. Suppose in the above question, the subsidiary issues its own equity shares to the employees of parent. Suppose in the above question, subsidiary issues its own equity shares to the employees of the parent, comma, pass journal entries in the books of both parties. Pass journal entries in the books of both parties. So now write down entry in the books of parent company P. In the books of parent company P, I will dictate, you will write. Listen to me carefully. In the books of parent company P, next line journal entries. Next line, journal entries. I am not writing journal entry and only one entry because it is a wasted option. Employee benefit expense account debit. Now who is enjoying the services? Parent. Correct. So parent will write employee benefit expense bracket P&L account debit. Same figure 2,17,500 to equity in bracket other equity to equity in bracket other equity in bracket dividend from subsidiary. Done. 2,17,500 being expense recorded. Being expense recorded. Being expense recorded. I'll repeat the entry employee benefit expense account debit to equity in bracket other equity in bracket dividend from subsidiary. Being expense recorded. Now write down one line blank first. Next, in the books of subsidiary. In the books of subsidiary. Equity oblique other equity account. Equity oblique other equity account in bracket in the same line dividend to parent. Dividend to parent. 2. Come on. To share capital. To share capital. We will directly write to share capital 25,000 because calculation have been done, and to securities premium 190 to 500 calculations have been done. Who is issuing the shares now? Subsidiary. So subsidiary will write to share capital 25,000 and to securities premium 190 to 500 is right. Being shares issued to employees of parent. Shares issued to employees of parent. Shares issued to employees of parent. Done. Only you have to change entries. Amount will be same. Write homework for today which you will do yourself. Solve question number 47 and 48 assuming subsidiary has issued shares to parents' employees. So apply your mind and write the entries. Keep one page blank. I think it will be little more than one page. You don't have to do calculations. Remember, everything will reverse. Take your notebook, first reverse it, okay? And then write. It will tally. But make changes wherever necessary. So keep 1.5 page blank. So that you will remember, yes, we have to do homework. Institute, what they can do, same problem. Only one line they can change. Subsidiary issued share to parent, and the student, some of them by hearts the answer also. We Indians are very creative. Okay. This Olympic should have creativity test also. Then we will show all gold, bronze, silver. Our only creativity. First of all, they will change the name of Olympics only to something else. Phantom share. Oh, phantom. Options. Or options having settlement choice. Now we are coming towards the end of the chapter. Choice. choice, what is the choice? Cash or equity. Choice to whom? What is the choice and to whom the choice is available? So that depends in the question. It can be with employee or it can be with entity. Instead of writing employee, counterparty, because this chapter is not applicable just for employees. It is employee and other non-employee also. So now the question will be how to do accounting when the counterparty has the choice either to demand cash or equity, and or the entity has the choice to either pay cash or equity. So that is called options having settlement choices. So this is a little complicated than what we have done, because I have to apply my entire knowledge of what we have learned earlier in a particular question. Institute does not use the word phantom options, but many authors use it. Okay, where you have the choice. Sometime option can be given choice for settlement in cash or share. Such options can be with the entity or with the counterparty. So that is very important in a question to check who has the option. Of course, it can't be with the both party. Can it be with both party? Then what will happen? Company may want to pay cash, employee may want share, company may want to issue share, idea company has issued ESOP, okay, so they want to issue share, employee says no, please give me cash only 20 rupees. Possible? So choice can be only with one party. If the option is with the counterparty, now entity does not know what he will demand. Is it right? If I have the option, I know what I am going to do. If I am the entity, if I have the choice, I am more or less, I have made up my mind what I am going to do. But if the option is with the counterparty, I don't know. I don't know what he will demand. So such instruments are called compound instrument, where the option is with the counterparty. Compound. Have you heard this word compound earlier? When? Financial instrument standard. Compound means a mixture of two or more items. So this is a mixture of equity and debt both. So what the standard says, if the option is with the counterparty, it is a compound instrument, then substance over form. What is substance over form? Identify how much is the liability portion and how much is the equity portion. How much is the liability portion and how much is the equity portion? Oh, this reminds you of IND 32. Yes, those who have learned IND 32, you have learned compound financial instrument. There also we did the same thing, because such instrument have some features of equity and some feature of debt. Is it right? So how do I solve it? First, you value the entire instrument as if it is equity settled. First, you value the entire instrument as if it is equity settled. That means company says, if you want cash, I will give you cash equivalent to 100 shares. Cash equivalent to 100 equity shares. Okay, equivalent. If you want share, we will give you 150. So first to assume as if it is equity settled. Numbers can be different. Usually the cash number is less. Equity number is more usually. So value this. This comes to, let us say, 15,000 rupees. Fair value on the grant date only. fair value on the grant date only. Write down on grant date. Fair value on grant date. Then calculate the fair value on grant date again, assuming it is cash settled. Assuming it is cash settled. So if I have to compute the fair value of cash settlement, let us say our answer comes to 12,000. Let us say how to do calculation I will show you in the problem coming after a few minutes only. So 15,000 is the value of the instrument. The liability portion is 12,000. So I will allocate 3,000 for equity. Is it right? Liability component will be accounted as SBP liability, or what is called stock appreciation right, and equity portion will be accounted as equity settled option. So now I will have to open two ledgers, or you can say three ledgers. One ledger is employee compensation expense account as usual. I will have to open SBP liability account also for recording the liability part, which will be fair valued every reporting date. Fair value will be transferred to P&L account. Equity will not be fair valued again. But of course, the equity value will have to be restated if the number of employees keep changing, like earlier. Is it right? The difference is called equity. If the value of equity settled option is more, if this is 15,000, this is 12,000, then the excess is recorded as SBP reserve, means equity. This excess value is transferred to per option value. Per option value means if there are 100 options, then maybe this 3,000 divided by 100 options. So it amounts to 30 rupees equity fair value, and then you do the accounting with 30 rupees. Don't change that 30 rupees because it is equity settled. Understood? But liability portion will be settled, or liability portion will be revalued every reporting date. Don't worry. Now the student will ask that old boring question, what if this is 12,000 and if this is 15,000? So your answer will be minus 3,000. If it is minus, ignore. Treat it as 0 only, and 15,000 is the liability component. Equity can't be negative. Equity component can't be negative. So if you are getting negative answer, treat it as 0 and ignore that in calculation and further accounting, and only do the accounting of the liability part as if it is a SBP liability problem. Revalue on every reporting date, transfer it to P&L account, any change in fair value, and you do this exercise till the settlement. Is it right? Provision for SAR is made for cash settled option, that is SBP liability. Two name you can write, either you can write provision for SAR, or you can give it a name SBP liability for cash settled option. This part, which in our example right now on the screen is 15,000, and the accounting is based on SAR, that is every reporting date remeasure the fair value. Every reporting date remeasure fair value. And transfer the difference to P&L account. That we have already done. SBP SAR accounting in previous lecture we have taken 7 or 8 questions. Do you remember? Oh, I forgot, I gave you homework also. Honestly answer, done or not done? Not done. So one good thing about you, you're honest. One bad thing about you, you're not done homework. Okay. Anyway, I believe honesty is more important. So I will excuse you. Now comes to the settlement date. Dang, dang. Employee comes. Here is the employer. Okay. So accounting will depend on what the employee or the counterparty wants. He says, I want cash. I want cash. So I have created two accounts. Which two accounts I have created? SBP liability account. If he wants cash, I am ready for that. SBP reserve for equity. So I will pay from SAR account. Provision for SAR or bracket SBP liability. If you are reading some other books, they may use SBP liability account to bank account. To bank account. Now the employer had two accounts, SBP liability, SBP reserve. This account will close because I am going to revalue it till the date of settlement. So whatever amount I have to pay, my book value is already upgraded to that extent and you have paid, so this account will close. You will answer now. What will you do with this SBP reserve account? My account should be closed because I have settled with the employee. So transfer it to general reserve entry. Already you are aware. SBP reserve account debit to general reserve being amount transferred. But suppose the employee says, sir, I want share. This is my liability account. This is my SBP reserve account. But the fellow wants share. And I have say 12,000 rupees lying here. He says, I don't want cash. I want share. Treat this 12,000 rupees. It belongs to whom? Employee. As if it is a consideration paid for the share. As if it is a consideration because he is willing to forego that 12,000 rupees to get the share. So don't you think it is indirectly a consideration he is paying? Otherwise, you could have asked for 12,000 rupees from the company. He says, I don't want 12,000. Instead of that, you give me the shares as we have already discussed, promised. So this is treated as a consideration for share. Imagine the entry. SBP liability account debit to SBP reserve. So first you close this account by SBP liability, 12,000. And you already have some buy balance brought down. Let us say 3,000. And then check in the question whether the employee is required to pay exercise price also. If he is required to pay exercise price, by bank, right here only. And then to share capital, to securities premium, and if options lapse, then for the lapsed option to general reserve. The proportionate amount will be transferred to general reserve if the options lapse. Although options should not lapse because employee can get the cash. Yes or no? You don't want share, don't take share. At least take cash. Why you are allowing it to lapse? But institute can allow you to lapse and therefore transfer to general reserve. Anyway, so I need to be ready for all types of possibilities. Entry. First you transfer provision for SAR to SBP reserve. Why? It is the consideration for the share. consideration for the share. In lieu of cash, he's getting share. So it's a consideration indirectly paid for the share. And then the company is going to issue the shares. Entry will be SBP reserve to share capital to securities premium. If exercise price is received, write one more line. If you have space on the left side, I think you have some space. Yes or no? If exercise price is received, then pass one more entry which will come before this, okay? Bank account debit to SBP reserve. Accumulate everything in SBP reserve. SBP reserve opening balance, amount transferred from liability account, that also belongs to employee, and the exercise price paid by the employee. So now you have so much of money, use it for issuing the shares. And if the balance remains, securities premium. If some option lapse, proportionate amount will be transferred to general reserve, that you can manage. So that is how this entries will be done if the option is with the counterparty. I have written this note also, if some options lapse, which I think should not happen unless the cash figure is zero, unless the market price goes down so much that he will not get any cash. Yes or no? Option should not lapse. But institute can give a question where option lapse even though the employee could have taken cash. I can't believe that. Human beings are inherently greedy creatures. Why is greedy inherently? Because when he was inside the womb of his mother was already greedy. So that gene has already got percolated. Yes or no? If option is with the entity, now be careful. Now I can have either or. Either I will account it as cash settled, or I will account it as equity settled, because you know what you have to do. You know what you have to do. You are doing the accounting, so you know what you have to do. So you have to make a choice only, but that choice will be like this. Check whether there is a present obligation of the entity to settle in cash. That means even though there is a choice, but that choice is meaningless. The choice is because there may be some obligation to pay cash only. The reason being, you have entered into a contract with the employee that we will issue you the shares, but your article of association does not permit you to issue shares only. So there is a legal restriction on that. So theoretically, you are keeping that choice, but the choice is not there. You have entered into a contract with some other bank or some funds provider that I will not issue the share to others. I will not let your stake get diluted. You can't issue the shares. That means you have to pay cash only. And past practice of the entity. In past also they had come out with such scheme, and in all such scheme what they had done? Paid cash. Oh, then this equity is just for a namesake. Correct? Do settlement in cash, account as if it is a cash settled option. So if such present obligation exists, record options as provision for SR. So it will be accounted as a cash settled share based payment plan. But if there is no obligation to pay cash, you don't have any legal restriction to issue equity. You don't have any contractual restriction to issue equity. You don't have a past history of paying cash. Then you can apply equity settled accounting. Okay. So institute will give you some hint. Hints are entity is not allowed to issue shares due to legal or contractual reasons. Memorandum, articles may not permit. Okay, then you should ask that such contract itself are invalid, where the company tells I have a choice to equity, but I can't issue equity. That is a legal matter. You please go in the courts of law. We are the student. We are the student. So therefore, I have to see, do we need to really issue the shares? The answer is no. Law does not allow because your articles prohibit. Some contractual reasons may be there, because nowadays you raise funds from investors. Okay, there are angel investor, private equity investor, venture capitalist, and all these people make you sign a what they call term sheet or something, or memorandum of understanding, and then it is written there clearly that without our approval no further shares can be issued, because your stake gets diluted na. In a company the valuation depends on your stake, not the number of share that you hold. It depends on your stake. If the company is valued at 1000 crore and your stake is 30%, you are valued at 300 crore. But suppose the valuation remains 1000 crore only, but your stake gets diluted because you have issued ESOP to somebody, your valuation automatically comes down to 280 crore. So valuation game is there. Nowadays valuation game is all over. Okay. So therefore they put restriction on this. Then entry has a past history of settlement in cash. Even though entity could have issued share, in all past similar schemes they have paid cash only. And then entry has a past history of giving choice at the end to the counterparty. Some companies, what they do, in the third year, that is last year, they will say, okay, don't worry, you decide. Although I have a choice, I ask you what you want, I will do that to keep you happy. That means again you have transferred the ball in the court of the employee. He can decide cash, he can decide equity. So if you have such history where you have let the counterparty finally decide, then we will treat it as cash settled option and do the accounting till settlement as if it is a cash settled option. Okay. Then the student will ask definitely the old boring question, what if I do accounting as cash settled, but finally we end up giving equity shares? You don't have cash only. Suppose you don't have cash after 3 years. So you will think it is better to pay equity share, don't pay cash. So don't worry. So you have created one provision for SAR account. Am I right? Entire amount you transfer to SBP reserve. If there is any exercise price, bank to SBP reserve, and then SBP reserve to share capital to securities premium. What is the harm in that? Is it right? So I am going to take this example in the next question, where the entity originally took it as a cash settled plan, but later they issued the equity. Reverse can also happen. If you are going to issue cash, SPP reserve to cash, it is as good as buyback. As good as buybacking the right of other party to purchase share from you by paying him cash. Okay, so that way we can do the accounting. So this is an important question on the screen. Question number 50. Tang, tadang, 50. If I am a cricketer, I will say 50. If I am a bowler, I will tell 50. Yes or no? Nowadays they have started doing this. The bowler 50, 5 wickets after taking 5 wickets. On 1 4 18. An entity has granted to its 100 employees options having following features. How many employees? 100. Keep a track. Some of them may leave also. And what is the grant date? 1/4/18. Features. Now they are given two choices to settle in equity. If you want equity, you will get 50 shares. Each employee will get 50 share on the exercise date. If you want equity, you will get 50 equity share on exercise date. But if you want cash, then cash will be 45 rupees. Sorry, cash will be for 45 share. That is the fair value of 45 share will be calculated and that much cash will be paid. 45 into fair value. It is number on exercise date. Exercise price is 18. It means if the employee wants to buy the share, if the employee is interested in buying the share, kindly pay 18 rupees. Okay? If he does not want to buy share, he will get cash. Cash payment will depend on the fair value or intrinsic value. Normally intrinsic value, but some question setter don't use the word intrinsic value, they use the word fair value. Okay, that is acceptable to that extent. Today, the fair value of the share settled option is 2700. Sorry, 27. 100 employee, 50 into 27. Sorry. Okay, just wait. Suppose I don't consider 100, just for one employee only consider. Is it 1350? That is the value of share settled option. 50 into fair value of share settled option. And then suppose I want to compute the value of cash settled option, then 45 share. Then 45. If you want share, 50. If you want cash, 45 share multiplied by fair value of cash settled option today. 1260. I think the difference is 90. So that is the value of equity settled component, that is called SBP reserve. SBP reserve per employee. Is it right? Or per 50 share you can say. If I want to calculate per share, 90 by 50, 1.8. That was written in your note. Just can you come to your note? It was written there. Calculate the value of equity settled option, I have done. Calculate the value of cash settled option, I have done. If the value of equity settled is more than cash, yes, 90, then this excess is recorded as SBP reserve. This excess value is transferred to per option value. So per option value will be 1.80 now. 1.80. So 1.80 will be per option, or you can say 90 for one employee. 90 for one employee. So if you are using employee for calculation, multiply by 90. If you are using number of options, then multiply by 1.80. So answer will tally. Multiplying by 50 into 1.8 or multiplying by 90 will give me the same answer. Anyway, so that was very easy. This is day 1. Vesting period 3 years. At the end of 31st March 19. Now every year they have to estimate how many employees will finally survive. 4 have left, 3% will leave in future. So you have 100 employees minus 4. Now we have 96. How many years are remaining? 2. So next year the employees will become 97% of 96. 2 years are over. Again in the third year, you have 97%. Understand what I have done? Student have asked me several times why we are multiplying 2 times 97. Hello ji, why we are multiplying by 97% 2 times? It is 3% per annum. ठीक है? So think like this, we have 100 employees at the beginning, 4 left, remaining 96. Second year 3% of this will leave, so minus 3%. So this is my employee head count at the end of year 2, 93.12, no problem. Again next year 3% will leave, 90 point. So instead of doing this long process, I will write in one line only, 100 minus 4 into 97% into 97%. I hope you will not torture me on this in future, okay? Now next year, 2020, okay, the most eventful year of your life, where you were jailed in your own home. 6 employees have left. So again do the head count, 100 minus 4 minus 6. These are at the end of year 2. Third year will be estimated and further 2 will expect to leave. Now see the presentation. Here it is 3% per annum. Here it is 2 employee. So don't multiply by 2% now. Purposefully they do such adjustment because institute also needs to earn money, na? If everybody pass in the first attempt, then the institute will have to go to court and apply for voluntary liquidation. Is it right? Finally, how many employees were there at the end of third year? 86. So in the last year, all calculations will be based on 86. Will you remember this number 86? They have given us fair value of the option on different dates. This is useless. Sir, why? Because once we have calculated the grant date value of equity component, SBP reserve, now that figure will adjust only due to change in employee. Okay, not due to other changes. This is relevant. Why? Because this will be required for SBP liability calculation every year. So 3 years do the normal accounting. After 3 years, now we have taken all 4 possibilities which they can ask in the exam. Either all employees, all 86 employees will demand cash. Okay, very easy. All employees will demand equity. Again, very easy. Third and fourth case. Third is more realistic. 52 employees will ask for cash. Give them cash. Rest. 86 minus 52. 34 employee opted for equity share. Very good. This is a realistic scenario. Human beings will behave differently. Last one, institute's creativity. 52 employees opted for cash. 30 opted for equity share. That was also understandable. And these 4 great employees, Mahatma type people, neither opted for cash nor share. At least he could have opted for cash. He's getting some cash. There is a 35 rupees value for one option into 45. That much cash you would have got. How much? 1575. Even if you are Mukesh Ambani, you will take 1575 if it comes free of cost. Yes or no? Anyway, we will have to search for who are these 4 employees. They must be given Bharat Ratna, Padma Bhushan together only. Now start the solution. Now this question has some error. They have not mentioned who has the option. Oh, so we will solve it by assuming that counterparty has the option. And the same problem coming after this, entity has the option. So we'll have to solve it two times. Okay. These options can be settled in equity or cash. So after reading the problem, student will carefully check who has this right to opt. Check who has this right to opt. Now in this question it is not clearly mentioned. It only says on 1418 entity granted 100 employees options. This 100 employee option means stock option having following features. Oh, there is a confusion. One word is stock option and the other one is option to choose. Understood the difference? So we don't know. Assume counterparty has the choice. And in the exam also you will start with this note. It is assumed that employee has the right to opt because your answer will change. If the entity has a right to opt, you will have to open either SBP liability account or SBP reserve account. But if employee or the counterparty has a choice, then I have to see, does this contract contain equity component? Yes, then there will be two accounts. So write down calculation. Keep the question in front of you continuously. I will require the figures from that question. It's a lengthy question. 4 times I have to solve. If the contract is suppose equity settled, then fair value, if equity settled option, fair value, if equity settled option is 50 into 27 is 1350. And second, fair value if cash settled option 45 share into 28. 45 into 28. How much? Therefore, excess is for equity settled. SBP reserve. SBP reserve. This calculation is per employee. Am I right? This calculation we have done for per employee. In some books, what they do, they multiply by 100 also. No problem. You can do that. You can do that. Mathematically, finally, your ledger should show the correct expense. Am I right? 90. Now write down. The student's query will come. What if this figure was negative? So for such students, this note, not for exam, but in one of the exams in old course, there was a question where this balance had become negative. Ignore negative figure, okay? If equity settled value was less than or equal to 0, less than or equal to 1260, less than or equal to 1260, the equity component will be 0. Equity component will be 0. Liability component will remain. Liability component will remain rupees 1260. So write here careful. Dang, dang. In the old course, when the share-based payment chapter was there, guidance note, there was one exam where it had become negative, and some of you have written negative entry also. SBP reserve debit. Yes or no? Negative means SBP reserve debit. You don't have to do that. Just ignore it. Right. Step number 3. Calculation of expense. 31st March 2021. I want you to keep the notebook and question book open and look at 31st March 19 data. First, look at the employee data. 4 employees left. 3% per annum will leave in future. As far as equity settled part is concerned, I will take 90 rupees only. That will not change. That will not change. But for cash settled part, I will take that 29 rupees. Can you see that 29 rupees in that chotu table in the last column? Small table? Yes, so I will take that. So right, first equity settled. Equity settled. Our formula remains the same. Number of options expected to vest, which is 100 minus 4 into 97% into 97%, 2 times, because 2 years are remaining. We are at the end of year 1. He will retire at the end of year 3. 3% per annum is the employee turnover into 90 into 1 by 3. Now here there are 2 ways you can present it. Please pay attention. Either you can write 90, which is per employee, or 50 into 1.80. Whatever suits you. 50 shares, 1.8 fair value, that is per share value. Whichever helps you to understand, you follow that. Anybody answer? 2710? Very good. Every year you have to do 2 calculations now. One for equity portion, one for cash portion. Cash portion, do this calculation. 100 minus 4, be active, into 97%, into 97%, into 45 share, into 29 fair value per share. Now here the student will get confused that I am multiplying by 2 numbers here, because this is number of share and this is fair value per share, whereas this 90 is already a product of number of share into fair value. So either way it is same, both are same. There I have written directly 90. That is why I said if you think 50 into 1.80 will help you, follow that number into fair value. But in case of cash settled, I have to do that because their 29 rupee is per share value, not for 45 shares together. Okay, come on, answer. Yes, 39,292. This is the first year expense. Listen to entry that I will transfer later in leisure. Entry will be employee expense account debit to SBP reserve 2710 to SBP liability 39292. 39292. Is it right? Oh, any query? Do it for year 2 yourself. If you have no doubt, it means you can do for year 2 yourself. 31st March 2020, question in front of you. Look at the employees first. 100 minus 4 minus 6, 2 more will leave in the future. So first equity settled. let us see who will give me the right answer for equity settled. Right answer will get a reward. Okay, a trip to Mars, free one-way ticket to Mars. Oh, it is 2570. Previous year you have to remove. Some student have not removed it. Yes or no? What happened? I think you have not deducted that. Every time you have to do. Every time. The purpose of taking practice in the classroom is, and asking you to solve is, you immediately realize where can you go wrong. One more, cash settled. The one who will give right answer will get a one-way ticket to Jupiter. Yes, please answer. Students who are studying at home will try on your own. Yes, 5 seconds more. Remove remove previous year also. Some of you are not deducting the previous year. Check the answer on the screen. The correct answer was 47828. 728. The typing error. Is this right? 828. Yes. Seems to be right. Check the calculation. 100 minus 4 minus 6 minus 2 into 45 shares. 33 fair value. Every year it will change. Into 2 by 3 proportion minus previous year. 39292. 47828. Right. Okay, try one more. 31st March 2021 equity settled. Person who will give right answer will go to Saturn. Mars, Jupiter over. Don't create crowd. Keep social distancing. Equity settled, anyone? Oh, wonderful. Now see, you have started getting right answer. You just need to be guided and then you will show your skill. Okay. Anybody? Cash settled. Cash settled. Cash settled. Yes. Take the fair value 35 rupees. Final answer. Anybody? Final answer. Waiting for you. Very good. 48 Most of the students have started getting it right now. That is the proof that you are learning. If you are getting it right. Third year you should get right because it is a repetition. Keep these numbers ready. When I will ask you, you will supply these numbers to me. For next 5 minutes now only entries you have to pass. 330. Check it again. Those who are getting different answer, do your calculation and check. 39,292. So I have, it was 292. So, but the answer is right, no? That may be typing error. It is 292 earlier. First one, okay, let us revise. The first year equity settled was how much? And cash settled was how much? 39292. Okay, that is what I had written. Second year was equity settled was how much? Cash settled 4828. Very good. And this is on the screen 2460. Yes, these are final. I will require them in ledger. First I'll explain. In SBP reserve, credit, credit, credit. In SBP liability account, credit, 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 these three numbers. So first 3 year smoothly do the entries. Then we will take those 4 cases when the employee will opt for cash or share or share, partly cash, and the fourth case partly share, partly cash, and some lapse also. So this will cover all types of situation. Understood? So any question in the exam now they will ask will be a subset of this. What is subset? Have you heard subset in the mathematics? This is set, this is subset. Okay? Out of this only. You are a subset of your family. Understood? Note. Note right. Fair value of equity options given on various reporting dates are not relevant. So you are given that 30, 32, 34 equity settled column. That is not relevant. That is given to test you. Equity settled options are not fair valued every time. They are equity. Done, everybody? And you carefully do this question. This is also tested in the exam. Anything for 8 to 10 marks. Start. Now I have all the numbers ready for 3 years. Case A, write down. Case A. Options settled in cash. Options settled in cash. Options settled in cash you have written. First account, provision for SAR account. Provision for SAR account. By employee compensation expense account. 39292. Is it there? So you have to participate. Now, otherwise, how will I teach? Is it there? Yes. To balance carried down. To balance carried down. 39292. One line blank. Take the total. Again 1419. Keep calculator also ready. For second year carry forward will be total. By balance brought down. Same figure. Anyone? Second year cash settled option. 47828. Wonderful. To balance carried down. 87120. 87120. By balance brought down. Speed, increase the speed. 87120. Third year expense, anyone? 48? Right, by employee compensation expense 48330. After writing this, see what you have written at the top. At the top, where I am circling right now. Options settled in cash. So pay cash. To bank, 31st March 2021. To bank. Same amount. That was easy. We have done it earlier. Have you finished it? Raise hand those who have finished. Okay. 80% finished. 20% still writing. Finish it first. This is an important question, trust me. Out of all the questions that we have done, This gives you idea about liability accounting also, equity settled accounting also. Next ledger, SBP reserve. SBP reserve. First year, 31st March 19. Go to your calculation of expense of first year. By employee compensation expense 2710. Is it there? To balance carried down 2710. First April 19 buy balance brought down 2710. Buy balance brought down 2710. Buy employee compensation expense. Second year was how much? Total is how much? To balance carried down total 5280. Yes or no? Third year, buy balance brought down 5280. Buy employee compensation expense 2460. But the employee has already opted for cash. He has taken cash and he has gone. So where will you transfer this balance in SBP reserve? To general reserve. Balancing figure 7740. Take total, write neatly with all details, date, total. If you prepare like this, then you will get full marks. Choice is yours. Have you done? Okay. Case B, write down. One line blank, next heading case B. Maybe you can use a different color pen for writing case A, B, C, D. So you will know where we are changing. And then according to what is asked, you have to write that portion. Okay. Case B, options were settled in equity. Options were settled in equity. Or you can highlight it if you have a highlighter. Done? Heading is written. Wait, I need to ask you something. Will the entry of year 1 and 2 change? Journal entry of year 1 and 2 will not change. Entry for expense recognition of year 3 will also not change. Only one line is going to change now. I am going to transfer the balance in this SBP liability to SBP reserve first, then receive the exercise price and then issue the shares. So third year ledger will change. So write down a note first. Otherwise you will have to spend your energy unnecessarily for year 1 and 2. Do you want to prepare all 3 years or only third year? Only third year. Knowing your intention, no, not my, I am only the person responsible for this notes. I have decided only third year ledger. I knew you will say this. Note, write down. Entry for year 1 and 2 will remain same. Entry for year 1 and 2 will remain same. The third year ledger is presented below. The third year ledger is presented below. Under that, provision for SAR account. 1/4/2020, go to your previous ledger. How much was balance on 1/4/2020? It is on 120. And by employee compensation expense was how much third year? Come on, be active. 48330. Credit side will be same. Credit side will be same. What will change now? On the debit side, don't write to bank. Then what will you write? This amount you treat it as a consideration for share issued. So 2 SBP reserve total 135450. Louder, yes or no? So this ledger will close like this in case if you have to issue only equity share. Come on, is it right? Can I go to the next ledger? Right below SBP reserve account, SBP reserve account. Draw the ledger. Third year, go to previous case 1 and check what was buy balance brought down on 1/4/2020. Was it 5280? Was it 5280? And by employee compensation expense was how much? Yes, so these two will be first recorded. Now you have transferred from provision for SAR to SBP reserve. So contra entry, contra effect, credit effect. Is it 135,450? 135,450. 135,450. Then the employee will also pay cash 18 rupees. How many employees are there? How many shares per employee? 50. Exercise price per share 18. So company will receive, multiply three numbers, 86 employees into 50 share into 18 rupees exercise price. Is it 77400? Is it understandable? Yes, come to credit side. I will have to issue shares also. Assume 10 rupee face value. Assume 10 rupee face value. I think it was given also. If not given, we have decided 10 rupee. Okay. 10 is the most common face value. 86 employee into 50 share. Number of share issued will be this amount. Into 10 rupee face value. Answer. So 43,000 and 2 securities premium. That is called balancing figure. Excess amount 177,590. Total 220,590. See the ledger on the screen. Just check you have written everything properly with all calculations. Calculations must be written. Later on, if you ask me how 77,400 has come, how 43,000 has come, first you have to transfer 200 rupees into my account, then I will reply. If you ask the same thing again, okay, you want my Paytm number? It is close to 222,222,222. Okay, that was just a joke. Don't try, your money will be wasted. Case C is little more complicated now. Hello, have you written? Case C, use a different color pen or a highlighter. 52 employees opted for cash and the rest opted for equity shares. 34, rest means 34. 34 employees. So some want share, some want cash. First you write a note. Entry for year 1 and 2 will remain same. Entry for year 1 and 2 will remain same. Right. Provision for SAR account. Provision for SAR account. Again, you please copy the credit side yourself. Copy the credit side yourself. That won't change. First two lines on credit side copy from previous note, previous answer, case B or case A. Any query on this? Wait and just wait for the instruction. Now on the debit side, I will have to write to bank and to SBP reserve. Two things I have to write. Yes or no? To bank and to SBP reserve. The question is how much amount you will write in bank and how much you will write in SBP reserve. So how many employees opted for cash? So give me the answer cash. Those will give correct answer. Directly you will get Pluto's ticket now. Okay. Huh? 46,800. 52 employees. Each employee who will opt for cash will get into 45 share into 35. 81,900. Yes, that was easy. I think you should have got it right. And to SBP reserve, balancing figure. To SBP reserve, you can take balancing figure or you can calculate also. Which is easier? Balancing figure. What is the answer for SBP reserve? 53550 total 135,450. 135,450. SBP reserve now. Same, first two lines please copy from previous case B. First two lines please copy. Credit side SBP reserve. So how much is that? 2460. Credit side, you have transferred from provision account, credit effect write down by how much? 53550. Was it difficult? And those who will ask for share, they will have to pay 18 rupees. And how many such employees are there? 34. Each employee will get 50 share into 18. So can you tell me by bank how much? 30,600. Right calculation, 34 employees. Those who can write 34 employees, right? Otherwise 86 minus 52. Otherwise 86 minus 52 into 50 share into 18 rupees is the exercise price. So 34 employees will be issued 50 shares, yes or no? And face value is 10 rupees. So 2 share capital will be 34 into 50 into 10. How much? 17,000. To securities premium, because all options have been utilized either in share or in cash. So nothing will be transferred to general reserve. Agreed? Nothing will be transferred to general reserve. So I will write to securities premium 74890. Is it right? 74890? Yes. Any query on this one? No. Why? Seems to have understood. That's good. Now write down KSD. KSD, what they have written, 52 employees opted for cash. So that part is same. I think that part was same. So this SBP liability account will again look like previous case 3 only. 30 employees opted for equity share. So this will change. SBP reserve account will have a little difference now, and options lapsed for 4 employees. An option lapsed for 4 employees. An option lapsed for 4 employees. So first you draw this note, write a note first. Entries for year 1 and 2 will remain same. Entries for year 1 and 2 will remain same. Third year will also remain same, but I will present it. I will present it later on. What it happens, it creates confusion where it has gone. You are right, it will be same, but I will present it. So third year, you are right, the provision for SAR account for third year, because the number of employees they have kept same, they should have given a different figure actually. So the question could have become little more entertaining. So draw it. Maybe in your exam from 50 they may make it 45. So this is how you will do it. Third year liability account will be same because the number of employees opted for cash given is same. What about those 4 employees who have not exercised? Their adjustment I will do in SBP reserve. SBP reserve. In any case, this balance I am transferring to SBP reserve only. So instead of writing at 2 places, I will only write in SBP reserve. Okay. This ledger is over. Everybody say yes. So can I go to next now SBP liability, SBP reserve account? Everybody, SBP reserve account. Opening balance same. Buy balance brought down 5280. Buy employee compensation expense account also same. Come on. How much? 2460. Amount transferred from provision for SAR also same. 53550. Up to this, it is same as case number 3. Stop. What is going to change? Number of employees exercising his right to buy share is only 30 this time. So buy bank, 30 employees, 50 share, 18 exercise price. Come on. 27,000. Wonderful. Amazing. Amazing. So credit side I have done. Whatever money I could have received, collected, transferred, done. Now this has to be allocated into 3 parts now, not 2 parts. I will have to transfer some portion to general reserve also, in addition to securities premium. So my question to this batch of highly talented student is, how much amount will be transferred to general reserve? To general reserve, Suppose I write and you give me the correct answer, this time directly ticket to sun only. Okay. Because beyond Pluto, I don't know what is there. How many employees have not exercised their right? 4. And how many employees are pending who have to exercise their right to buy share? 34. So the ratio of employees not exercising to the number of employees who should have exercised his right to buy share is 34. 4 by 34 you have understood. Not 4 by 86. 52 have taken money, they have gone. Their story is over. 34 employees are standing here, 4 of them have withdrawn. So the ratio is 4 by 34. And this money, the first 3 item, belongs to them. It belongs to these 34 employees. It belongs to these 34 employees. It is their hard work. They have services they have rendered. So multiply by the total of this 3 figure if I do, that will give me the proportionate amount to be transferred to general reserve. Why not 27,000? This 27,000 is brought by the 30 employees. So don't consider that. So I will write neatly. On the debit side, don't worry, I'll explain again. 7211 is the answer. To share capital, write down. First you write down whatever is easy. Share capital you can write. 30 employees, 50 share, 8 and 10 rupee face value. So when you write the easy thing first, your mind is working in the background for the difficult part. Is it right? And then to general reserve. 4 employees. Now there are 34 employees here in this queue to take the share. 4 people said no, sorry, I don't want. So 4 divide by 34. And how much money belongs to them? This belongs to them. This is the value of the services they have rendered to the organization, which they are willing to forego. So 4 by 34 into the sum of the first 3 number. Of course, this you will not consider because this is the fresh cash brought in by remaining 30 employees. Only 30. So they can't claim on that. Is it 7211? Now remaining balance now. To securities premium. 660. Check 66079 balancing figure. This ledger is closed now. Homework. Revise all 50 questions. Today's homework, revise all 50 questions. Okay, you will not find 50 questions in any book at one place. Arrange topic wise. Okay. And some more questions are waiting for you tomorrow. Now we'll continue tomorrow.